Hello grade 12s. Today we'll join Thabo, who's shopping around for a loan to pay for an overseas holiday. He has been to various financial institutions and came up with two options that he likes. Loan A is payable over 3 years and Loan B can be paid off over 4 years. Thabo needs to ensure that he does not choose a longer term to pay off his loan, just so he can afford the monthly payments, as this can end up being very expensive. Let's look at this in more detail. The 3-year loan is paid over 36 monthly installments of 815 Rand and 9 cents. The 4-year loan is paid in 48 monthly installments of 667 Rand and 78 cents. Each of these loans have the same fees: a once-off initiation fee of 1,140 Rand, a monthly service fee of 57 Rand and a monthly insurance fee of 86 Rand. A monthly repayment of 667 Rand is far more attractive than one that is over 800 Rand a month. But which one is more expensive in the long run? After 36 months of paying 815 Rand and 9 cents, Thabo will have paid a total of 29,343 Rand and 24 cents. After 48 months of 667 Rand and 78 cents, Thabo will have paid a total of 32,053 Rand and 44 cents. It makes more sense for Thabo to choose Loan A over 3 years. Both of these loans are based on fixed interest rate. Banks sometimes also give the option of having a fixed interest rate or a variable interest rate. A fixed interest rate will have the same repayment every month. A variable interest rate is linked to the national interest rate, which is released quarterly. As the interest rate goes up and down, so will the repayments of the loan. Thabo has received a quotation from his local bank, and on the quotation are a long list of conditions that he and the bank must adhere to during the course of the loan. Let's help him now to understand some of the main conditions listed. The document starts off with a list of definitions. Like most legal documents, these are listed in alphabetical order. Borrower: the person who is borrowing money from the bank. Collateral: security provided to secure the repayment of a loan obligation. Credit limit: the maximum amount of money that can be borrowed. Loan: the amount of money that is lent from the financial institution. Payment date: the due date for payment of all amounts due and payable as shown on statements. A signed surety is an undertaking by another person who undertakes to pay in full or in part the amount owing in terms of an agreement in the event of the borrower not repaying the debt. Two of these definitions can be a little confusing. Collateral is an item which the borrower, in our case Thabo, promises to the bank in case he can't pay the remainder of his loan. A signed surety is a person who agrees to pay the rest of the loan if Thabo cannot afford to pay it off. As with all loans, the payment arrangements are the most important conditions to comply with. The bank requires that payments on a loan be made on the due date. If not, then the bank adds additional interest onto the amount owing. If payments are not made correctly, the loan will be in default and the borrower will be facing extra bank costs or even legal costs. If Thabo is unable to make a payment, he should speak to his bank so that they can recalculate his repayments. The bank calculates the interest payable according to a strict formula. If a payment is not made on the due date, new calculations are done to charge interest on the arrear amounts. This condition is laid out in 4.2 of the loan agreement. In 4.3 it says, "You have the right at any time to pay in advance any amounts owed to us without notice of penalty, irrespective of whether or not they are due." This means that the borrower can pay extra amounts on the loan when they're able to. 4.4 says you may not be able to draw against certain deposits, for example, bills, checks, debit orders, to your account until they've been duly and legally paid, even if your account has already been credited. Such funds are subject to a 7 business day clearance period. This clause protects the bank and its customers from fraudulent activities involving people making false deposits and withdrawing the cash from an account before the money has been cleared by all parties involved. This means that you cannot deposit a check and draw out cash before the check is cleared and the cash is available. We are now going to spend a little time discussing costs, fees, and charges, as Thabo needs to carefully analyze these before accepting the loan. On every loan, there are compulsory finance charges and levies that are charged on a monthly basis. The loan initiation fee is a once-off payment paid at the beginning of the loan period. Secondly, there is the monthly service fee of 57 Rand. This is the maximum amount that can be deducted by banks for administrative costs and is governed by the National Credit Authority, or the NCA. Lastly, there may be an insurance fee that covers the payment of the loan in case the person borrowing the money cannot pay back the loan due to death. This will depend on the security that the borrower has to offer for the loan. When Thabo decides whether or not he should accept the loan offer, he should take a careful look at the term of the loan as well as the interest together with all the other applicable conditions. Thank you for joining us, Grade 12s. Remember, the tasks for this section can be found in the Finance of Business task video. You'll also be able to learn more about finance on our website www.mindset.co.za/learn. Goodbye.